welcome to this deep dive. Today, our mission is explicitly for you, the listener, to uncover the hidden psychological traps of decision-making.
Yeah, and risk management, really.
Right, risk management. Because we are going to look at how perfectly rational, highly analytical people end up trapped in these deeply irrational, mathematically dangerous situations.
Which happens way more often than you'd think.
Oh, absolutely. And the foundation for our exploration today is this really fascinating document titled, "You Wouldn't Take This Trade, But You Already Did."
Yeah, it's a great piece. It was written by Rob Mitchell.
And just to give you some context on who we're learning from today, Mitchell is the president of Axiom Research and Trading Incorporated.
Right, and he's also the founder of IndicatorSmart.com.
Yeah, plus, he's a former Robbins World Cup E-mini trading champion. He has over 30 years of experience in this space.
30 years of just, watching human behavior in high-stress environments. He's also the creator of ManifestingYourFutureNow.com, which is important because it ties into the psychological side of things.
Exactly. Now, before we go any further, just to make sure we're all on the same page here, what exactly is an E-mini?
Oh, right. So an E-mini is basically an electronically traded futures contract.
Okay.
It represents a fraction of the value of a standard futures contract, usually tied to a major index like the S&P 500.
Got it. So it's moving fast.
Brutally fast. The key thing to understand about the E-mini arena is that it is highly leveraged, it's fast, and it's just incredibly unforgiving.
So winning a world championship in that specific environment.
It requires an absolute rock-solid mastery of risk management. You can't just be lucky.
Right. So this is a guy who understands high-stakes pressure testing.
Yeah, absolutely.
But what we are looking at today isn't just a technical manual on, moving numbers around a screen.
No, not at all. This isn't just about the mechanics of trading. It's about Mitchell's broader work in probabilistic frameworks.
The psychology of it.
Exactly. He argues that success in any high-stakes environment isn't just about reading external data. It's fundamentally about reading your own mind.
The vital connection between mindset, perception, and performance.
Yes. And that is exactly where this text begins.
Okay, let's unpack this. The core premise Mitchell presents here challenges basically everything we assume about our own rational decision-making.
It really does.
He's talking about how you end up in a situation where there is absolutely no structure. There is no edge.
Right. An edge is a trading term for having a statistical advantage.
So you have no advantage at all. You were just chasing the price of something. And the risk you were taking on is massively bigger than the potential reward.
He presents this dynamic with a very stark, objective reality check right at the beginning of the document.
It's a great opening.
Yeah, he poses this hypothetical scenario to you. He says, imagine someone brings you a chart of a trade. You look at it and the metrics are just terrible.
Just off.
You'd be arriving to the party late, chasing the price after the main move has already happened.
The train has left the station.
Exactly. The risk of total ruin far outweighs any tiny potential reward you might manage to scrape out.
I mean, if someone handed that proposal to me across a desk, I would instantly reject it.
Of course you would.
I'd look at the math, see the massive downside, and say, that's a terrible trade. I'm not doing that. You wouldn't even hesitate.
No, because in that moment, the proposal is static. It's a detached external piece of data.
Right.
Your rational actor steps in. You use the prefrontal cortex, which is the logical analytical part of your brain, to easily calculate the probabilities.
And you recognize that the math simply does not work in your favor.
Exactly. You reject it.
But here's the massive paradox that Mitchell points out. And this is where it gets a bit uncomfortable for all of us.
Yeah, it hits close to home.
He says that this terrible mathematically flawed trade that you just confidently rejected is the exact trade you were already in.
You just don't recognize it yet.
I mean, it's like looking at a house with a caved-in roof and saying, I'd never buy that. But somehow waking up and realizing you're already paying the mortgage.
That is a perfect way to put it.
But I have to push back a little here. How do highly analytical people end up in a position they would objectively hate? If these are mathematical thinkers, why doesn't their mental spreadsheet just flash red and tell them to get out?
Well, what's fascinating here is the severe disconnect between our objective external analysis and our subjective internal experience.
Okay, what do you mean by that?
When you look at a bad deal from the outside, you're evaluating it as a single, isolated event.
Like looking at a photo.
Exactly. But Mitchell diagnoses the core mechanism of how people get trapped. The problem, as he states so clearly, is that you didn't enter the terrible trade all at once.
Ah, So we aren't just making one giant leap into a disastrous position.
No, not at all. You slide into it.
We're sliding.
Yes. Mitchell refers to this psychological phenomenon as the drift.
The drift?
It's a step-by-step breakdown of discipline. You don't wake up and decide to ruin your portfolio or tank a massive project at work.
Right.
You take a slow, almost imperceptible slide into the trap.
Let's walk through the exact anatomy of this drift, because Mitchell lays it out with terrifying precision. And honestly, I think it applies to so much more than just the stock market.
Oh, without a doubt.
It always starts small. Imagine you're sitting at your screen, you see a move happening, and you chase it just a little bit late.
You're just slightly behind.
Yeah, you think, I missed the perfect entry, but I can still catch the tail end of this momentum.
Right. You compromise your initial strict criteria just slightly. It doesn't feel like a big deal.
But then the inevitable happens in a chaotic system. It goes against you.
The market moves the other way.
Exactly. Now, your original premise for taking the action is officially flawed.
So rationally, this is the exact moment you should just cut the loss and walk away.
But that's not what happens. Instead of exiting, Mitchell says you hold the position.
And why do you hold?
Because you tell yourself it should come back.
Yes. The introduction of the word should is the first major red flag that you have abandoned a probabilistic framework.
Because markets don't care what should happen.
Exactly. Markets don't operate on what should happen. They operate on what is happening.
Right.
But the reason the brain clings to the word should is deeply rooted in how we process failure. When the market moves against you, you just have a paper loss.
It's just numbers on a screen.
Right. It isn't quite real yet.
So as long as you don't close the trade, you haven't technically lost.
Exactly. The human brain hates realizing a loss. Closing that trade transforms a hypothetical paper loss into a permanent, real-world failure.
Wow.
As long as you keep the trade open, your brain tells you that you haven't actually failed yet. You are keeping the hope alive.
It's a complete refusal to make the failure real. So the drift continues.
It gets worse.
Because it hasn't come back, you take the next step. You add to the position. Or you manually override your own safety nets.
Yeah, the stop losses.
Right. You go in and widen your stop loss, meaning you increase the amount of money you're willing to lose before the system automatically kicks you out.
Yeah.
You decide to just, in Mitchell's words, give it room.
And this raises a really important question. What is the nature of the internal story you are telling yourself at this exact moment?
Right, because each of these steps must feel justified in the moment, right? They wouldn't do it if it felt like a massive error.
Exactly. Mitchell emphasizes that these terrible trades do not stem from one singular, catastrophically bad decision. They stem from a series of small, what he calls reasonable decisions.
They rationalize it.
Yeah, every adjustment makes perfect sense in the immediate moment. Widening the stop loss by just a little bit feels prudent.
Like you're just protecting the investment you've already made.
Right, and that completely blinds the trader to the mounting overall risk. They fail to realize that the overall environment has become totally toxic.
Here's where it gets really interesting, because at this point, the math of the trade has completely changed from when you first entered it.
Oh, entirely.
Your risk is now massive, and your potential reward is practically non-existent. But Mitchell points out a fundamental shift in the brain that happens right here.
Yeah, the psychology completely breaks down.
He says that at this stage of the drift, you look up and you realize you are managing a position you would have instantly rejected. You are no longer even thinking about risk versus reward.
No, your entire focus narrows to one single desperate goal.
Getting back to even.
Getting back to even, that is the exact moment the mindset breaks.
You stop thinking like a trader and you start thinking like someone who is stuck.
And the implications of that are profound. Drawing on Mitchell's deep focus on mindset and perception, we have to understand what it means to abandon that probabilistic framework.
You aren't calculating odds anymore.
No. You are no longer executing a strategy. You are operating in a state of survival. You are just desperately hoping for a bailout.
It's pure sunk cost fallacy mixed with adrenaline. You've invested so much time, emotion, and capital into this failing structure that walking away feels physically worse than staying and hoping for a miracle.
Which is incredibly dangerous because the market is an entirely objective machine. It does not care how much emotional pain you are in.
Right, the market doesn't feel sorry for you.
Not at all. It only processes the orders you input.
Okay, so we have this intense micro-level panic. You're staring at the screen, sweating, just praying for the line to tick up a few notches so you can get out at zero and pretend this never happened.
A feeling many people know too well.
But Mitchell doesn't stop at the individual psychology here. We have to transition from the micro, the individual, to The macro, the market itself.
Yes, and this is perhaps the most crucial insight from his 30 years of experience. He points out that this behavior, this slow drift into panic, is not random.
So what does this all mean for the listener? If everyone is doing this, do we just become a statistic?
Well, if we connect this to the bigger picture, Mitchell provides a striking and somewhat unsettling conclusion. He says, you've become part of the pattern.
You become part of the pattern. That is wild.
Because your isolated panic merges into the broader market dynamic. Mitchell notes that this specific psychological breakdown happens precisely at the edges of ranges, at market highs and at market lows.
Because everyone is experiencing the drift at the same time.
Exactly. Traders predictably chase the price. Or they fade it, assuming the trend has to reverse. They take their profits too early out of fear, or they hold on to their losers way too long out of hope.
So wait, you are literally creating the market structures at those highs and lows.
Yes. By drifting into this bad trade and reacting out of sheer desperation, your collective behavior builds the resistance levels on the chart.
That is just mind-blowing. You think you are sitting at your computer independently analyzing a chart, but your predictable human psychology is actively building the trap you are caught in.
Which is why Mitchell says the absolute best traders differentiate themselves in a very specific way.
How so? Do they just manage the bad trades better?
No, that's a common myth. The best traders differentiate themselves by avoiding becoming the trade altogether.
They just don't play that game.
They recognize the very first sign of the drift. The moment they feel the urge to chase a late entry or widen a stop loss because it should come back, they realize their psychology is slipping.
And they sever the connection immediately.
They take the small, realized loss right then and there because they know they cannot allow themselves to slowly slide into a terrible trade.
This is such a powerful synthesis of human behavior. Let's really pull all of this together for you, the listener, because we've gone on quite a journey today through Rob Mitchell's framework.
And it is a framework that applies far beyond just the E-mini futures market.
Exactly. The core lesson here from Mitchell's 3 decades of experience is that the danger that ruins you isn't necessarily one massive, blindingly obvious bad call.
If it were obvious, your analytical brain would reject it immediately.
Right. The true danger is the series of small, reasonable-seeming compromises. It is the quiet, invisible stripping away of your objective edge, one tiny, justifiable rationalization at a time.
Until you're fully stuck.
Exactly. So why should you care about this if you don't even trade stocks? Because recognizing the drift can save you from devastating, compounding errors in absolutely any high-stakes environment.
Whether you are managing a massive corporate project, running a small business, leading a team, or even just navigating a complex personal relationship.
You need to maintain a clear, strategic mindset. You need to recognize the exact moment when you have abandoned your original logical premise and are now just operating out of a desperate need to get back to even.
Because once you are fully in it, your ability to reason objectively completely vanishes.
Which brings us to Mitchell's most powerful quote from the entire text. It's a statement that really serves as a cold splash of water to the face. He writes, "You're not trading anymore. You're negotiating with a mistake."
That is the ultimate distillation of the trapped mindset. Negotiation implies that you have some sort of leverage. But when you are stuck in a structure with no edge, you have zero leverage. The mistake owns you.
You are just pleading with reality to change its rules for you. Just let me get back to zero, and I promise I'll never do this again.
But reality does not care about your emotional need to get back to even.
No, it does not. So we want to leave you with a final lingering question to mull over today. Step away from the financial markets for a second. Think about your own life outside of work and charts.
Yeah, look at the plans you've drawn up for yourself.
What terrible trade or bad position are you currently stuck in, simply because you drifted into it one small, justifiable compromise at a time? Look closely at your current situation. Are you still actively trying to execute a winning strategy, or are you just negotiating with a mistake?